Hello, and thanks for joining us today. I'm going to talk today about something that I hope will be very useful for you in your practices and helping your clients and advising your clients. And that is, in essence, and if I leave you with one thing that that out of this talk, and in essence, you should be constructing portfolios that have high active share, active portfolios, and we'll go into those that are and those structurally that can't be, and why, and that you should be choosing those managers who run an active portfolio and have skill. And I think it's that combination, blending managers who have a high active share, who are active and truly active, and have skill, that leads to positive client outcomes. And I think that's crucial for advising your clients. So in essence, the message is that alpha doesn't follow the crowds. The bulk of South Africa and the bulk of South African markets don't follow the advice and the points I've just made, and I'll get into that. So what I'm going to cover today is firstly how I understand your portfolio construction challenge, and hit on a couple of points that I think are real problems in dealing with advising your clients properly, from your client's point of view and from yours. The importance of active share as a measure of truly active management, and we'll go into that, delve into that. And then putting forward the proposition that Camissa, our portfolios are truly active, and demonstrating that to you and why that would be useful, and also putting forward that we are truly skilled, and so therefore we meet those criteria of being an active manager who is skilled. And then finally, given that context, what is our current portfolio positioning, and where that high active share or highly active positioning relative to where the bulk of the market is and where benchmarks are, where that lies right now. So getting into the first part, which is really my understanding of your challenge. The challenge I think you have is firstly seeking out differentiated returns. I think too often our country and our market is positioned in funds that perform reasonably similar through reasonable time periods. And truly finding out and putting together a blend of managers who can be differentiated and be above average is a very difficult challenge. I think one of the key messages, I'm not going to get into in too much detail today, but one of the key consequences of choosing truly active managers who have skill is that in the short term they will disappoint. It's just a fact of life. If you're differently positioned and you're taking market prices from a market which moves in all directions based on short-term phenomena and human psychology, they will disappoint in the short term. And the key challenge that you have when choosing a skilled manager who's active is staying the course and getting the very positive long-term returns that they will deliver. Obtaining value for the fees that you pay is also a key challenge. There's huge client pressure at the moment to reduce fees as a guaranteed way of adding to the client proposition. And what I'm going to put forward to you today is that that's not the first port of call, the first objective. First objective should be to truly get investment returns net of fees that are exceptional or that are well above average, not focusing first and foremost on the fees. Then I think the fact that risk-averse clients are what one faces, people are risk-averse with their hard-earned life savings, is a challenge for you. Because to put together portfolios of managers who are not household names is a difficult ask. And blending managers who may be a lot less well known but fit that bill of being truly active and having skill is a real challenge when clients are as risk averse as they have. And in that context, feeling the strong pull from the big brands, which your clients do know, and how strong that is as a force to guide the market to follow the crowd, and sit with a small number of managers who are severely constrained, in essence, in their ability to be active. And some of them, I think, have a doubtful track record that therefore you wonder with the personnel that they have today, not necessarily the personnel that delivered the track record, whether they actually have skill meeting that second criterion. And then I think there are a variety of behavioral biases that one needs to overcome. And those are multifold, but just some would be a recency bias to crowd towards funds that have recently done well. And that might be because of luck or circumstance, or to the human need to be risk averse and to not want to stick out and therefore do what everyone else is doing. That's another huge bias that one needs to face. So this sets out, I think, as a platform for talking about the rest of what I'm going to talk about, what I see as your challenge. And I'm going to try and address how one overcomes this challenge and these challenges. So firstly, to introduce the concept of active share. Now, in simple terms, it's the degree of difference from passive or from a completely inactive portfolio positioning. So it's the degree of being active. So one can be slightly active or very active. And so active share is an objective measure that you can calculate, or that you can get a very strong impression about how different your manager is from the benchmarks, from a passive solution, and also from all those other managers, large and small, who may crowd around the benchmarks or crowd around each other. It's an objective measure, which I think this is a key point. It's an objective measure of whether a manager is doing their job. If a manager is charging an active fee, they need to be truly active through time. And therefore, active share is a key measure of that. It's a measure of whether they are earning their fees. And getting back to that concept of value for money, I think it's a key request from you is, if you are paying active fees, the manager has to be active. It's a measure of whether a manager is confident in their abilities. And so the point really is that if a manager has high confidence and courage, they will deviate materially from what others are doing if their skill and their research and their approach warrants that. And then it's a key measure of prioritizing client interests over business interests. And what I mean by that is, as a manager grows very large, there's huge pressure from a variety of constituencies. So, for example, their shareholders in particular, for that manager to grow and grow the dividends and grow the earnings of that company to the maximum. And that's in the business interests, in the shareholder and the stakeholders' interests. But it can, and it often does, warrant or work precisely against the client's interests, because a manager runs out of bandwidth to be able to be truly active. And what makes this situation even worse is that managers that are successful and gather a lot of assets point to a track record which is multi-decade in nature, which is not replicatable because they are now far too big. It was a track record which was generated when they had a lot of active share, or the ability to have a lot of active share, and it therefore is a false view of what is coming down the track if you become a client or you stay a client of them. So I think this measure of active share and being truly active is also a critical gauge on whether a manager is acting in your interest and your client's interests, or whether they're acting in their shareholders' interests. Now, getting back to that key message that I want to leave you with, and if there's nothing else that you remember from this, it's this: that long-term consistent alpha or superior returns is the result of running high active share consistently, in other words, being truly active, and being more right than wrong in those positions that you take. And so that's the measure of skill. So being active and having skill is the key solution here. So drilling into and putting your thinking caps on, drilling into the more technical aspects. How does one measure active share? And one doesn't necessarily have to do this precisely yourself, but you can get a sense of whether a manager is truly deviating from the norms and from benchmarks and from what everyone else is doing and from consensus by this measure. So active share is measured mathematically as the sum of all the percentage deviations from the index, or from some measure of consensus or what everyone else is doing, divided by 2. So just to make that come alive a little bit, if a manager has 5% of a fund that has a 3% passive or benchmark weight. That's 5 minus 3 is 2. So that's a 2% deviation. That's an overweight. Likewise, negative deviations count as positives. So if a manager has a 1%, in other words, a 2% underweight, then that's a 2%, also a positive 2% deviation. It adds to the calculation. So you add up all those deviations, positive and negative, all of them as counting as positives, and divide by 2. Okay, then for illustration then, let's take a passive fund, a pure passive fund where there are no deviations from the benchmark. Clearly, with 0 deviations across the board, that's a 0% active share. That's an easy one. Now, if you had just a 10% overweight position in the banks in your portfolio, and therefore, consequentially, a 10% underweight in everything else, 10 plus 10 is 20, divided by 2 is 10. So that's a 10% active share. Easy. Another easy one is if you had 0% in Naspers and Prosus, which in our benchmarks is capped at 12%, then you would have a 12% active share. So 12% deviation from 0% of Naspers and Prosus, and then 12% more of everything else. That's 12 plus 12 divided by 2 is 12. So that's just setting the scene of the mathematical background to active share. Now, this busy graph here shows you a study done by Vanguard in the US on the results, the alpha, the outperformance on the y-axis of a variety of managers in the US and through a period of time, and those that run various active shares on the x-axis. And what you can very much see is that the alpha clusters around naught. So one needs to choose those that have skills, so above naught. But also you can see that the deviations can be much more positive as you run more active shares. So this is the evidence really that on the one hand you need to be bold, which you need to run more active share. And then the second very important part of it is you need to be right. You need to be more right than wrong, in other words, have skill. So that's the mathematical evidence for something which is really quite self-evidently apparent. Now, in the South African context, there are many hurdles and barriers to being able to run high active share. The first one, and a critical one, given where most people have their life savings invested, is that we have a very concentrated equity market. So this picture here just shows you the JSE broken up by value, and it looks more complicated than it is. Here, what we're talking about is the x-axis is the first 5 companies. It's the number of companies, then the next 5, then the next 5, all the way up to 50 companies. And how much on the y-axis of the market value do they make up? And you can very, very clearly see it's a very steep drop-off as one gets a larger number of shares. So to put that into numbers, the first 5 stocks alone, and this is with Naspers and Prosus capped at 12, make up a third of the market. That's a staggering concentration. The first 5 companies make up 1/3 of our market value. Add the next 5 and you've got to almost half of the market. So the first 10 make up almost half the market. That's 10 stocks of half the market. You take the top 20, that's 2/3, and then it drops off precipitously. The top 50 shares in our market make up 90%. But you can see how little obviously it's 1/3 from sort of 21 to 50. Now, the rest of the market, the rest of those stocks make up only 10% of our market value. Now, this is problem number one, because large managers, when you have a large asset base of SA equities, you have to hold, mathematically, you have to hold the bulk of your portfolio in the top 25 shares. So, because that's where the market value is. Now, that has 2 problems for where the bulk of our market is invested. It forces your active share lower, firstly, because you have fewer choices and your big benchmark stocks need to be a large portion of your portfolio. But then the other consequence of is that for those that do try and be more active, it materially raises their concentration risk. So what I mean by that is you need to take, to get to a reasonable active share position, reasonable deviation from passive, you have to take very large positions, very large active positions in a small number of stocks, and that's concentration risk, which reduces diversification, which is one of those bits of magic in portfolio management to reduce risk, is diversification. So you have a reduced diversification. So a real inability to deliver high risk-adjusted returns. The second consequence is almost the mirror image of that, is what they're forced into is the large stocks. What they're unable to invest in is the medium and smaller stocks. So large managers cannot create active share with mid-caps. And to put that into numbers, let's do a thought exercise here. So, and looking at if a large manager, and then many of our large managers have this feature, 300 billion Rand in SA equities. Now they have 600 billion or around that plus in total assets, but of that, SA equities make up roughly half. If a manager like that with firm-wide assets of 300 billion owned 100% of the following companies, how much would that be in their portfolio? So famous brands are South African champion of quick service restaurants, which owns Steers and Wimpy and Debonair's and others. If you own the whole of famous brands as a large manager, this is just one large manager, you'd own 2.1% of your portfolio in famous brands. Now, clearly that's physically impossible. You can't own 100% of a listed company. You'd have a much smaller position. If you own the whole of Datatech, an international IT distribution business, you'd have 3% of your portfolio, 3.3%. PPC, South Africa's largest cement producer, you'd own only 2.6% of your portfolio. One manager if you own the entire PPC. That's a very tiny amount. Brait, which owns Virgin Active and has we think quite strong prospects, you'd own 2.9%. Omnia, a leading explosives and fertilizer business, you'd own 3.8%. And then Cura, the private school business, you own the whole of Cura, it wouldn't even make 1% in your portfolios. Now, clearly, if one manager owned these companies, the whole company, you're still not getting to a meaningful position in their portfolio. And there are a lot more than one manager who have assets of this size. So clearly, these sort of companies cannot be invested in. But practically, that one manager, if they were to like these, what sort of position would they be able to take? I'd argue much less than a quarter of these companies is practically possible. So you're looking at dividing those portfolio weights by at least 4, probably more like 10% of those. And if you do that sum, you'll see that they're almost inconsequential. I mean, Cura, you'd go down to sort of 0.1% of your portfolio is realistically possible, 0.1, 0.2%. That's never going to move the needle if that's a good investment idea. So as a consequence of this concentration and an inability to invest materially in your portfolio in mid-cap and small-cap shares, large managers, and because they need to manage their risk, business risk, they migrate down the active share curve as they grow. So they migrate from being value-adding managers that are either concentrated stock pickers in this graph or diversified stock pickers, as Vanguard classifies them, to be closet index fund managers, earning high active fees, amazing marketing, but delivering mediocre outcomes for clients if you're lucky. So they lose their scope to maintain high active share due to this extreme market concentration, and most need to manage their business risk, and it's very rational in many respects. You could argue for them to do that. So they don't want to stick their neck out, and they want to remain on the fairways, and that reduces the potential for good client outcomes. And they still show smaller manager track records. Few, therefore, now justify their high active fees, in my view. And those high active fees, I think you need to always in the back of your mind when you see effective marketing and advertising and airport advertising and TV advertising, question where that comes from. It comes from harvesting the fees from the clients, these substantial assets that they manage and the substantial fees that they earn, bolster their marketing budgets for client retention and harvesting. So the problem is that most investors follow the crowd. And I'd argue that most advisors follow the crowd too. So not only do the managers follow the crowd and follow the benchmarks and benchmark hug for a variety of reasons that I've set out, but also advisors do too, which exacerbates the problem. And if you don't believe me, let's look at the size of funds out there. So there are a few massive funds in our market. So let's look at the unit trust market for equity funds. And here we can see that the large equity funds are 50, 30, 15 billion Rand in size. And this is just one, those are just one fund from one manager. On the right-hand side there, you can see it's sort of 35, 30s, very large funds. And clearly these managers don't only have that fund, they obviously have many other funds. Let's look at the balanced fund category. The largest balanced fund manager, one manager, 217 billion rand for a balanced fund. Now, that's a large ship that can't be moved around much. It can't be moved around very frequently, and it cannot run a very high active share. Manager 2 there is 132 billion, which is also huge for a one balanced fund, and then 9147. And then finally, looking at the stable fund category, 56, 32, 21, 19. So I think incontrovertible evidence that not only do the managers crowd around benchmarks and crowd together, but advisors do too. They crowd into a small number of funds and therefore also reduce. They're flocking to managers who have lower active share or higher concentration risk. So as a result, most investors in South Africa don't get much active share. So to put that into numbers, what we did is we took the largest equity funds in the South African market and calculated what their active share is currently. And this is where the bulk of clients out there, not necessarily your clients because you're listening to me today, but the bulk of clients out there are invested. They range from about 38% to about 45% in active share. So those are the large popular funds. Now, what I'm going to show you next is staggering. What most people do is they choose to mix those large funds. Now, what happens when you mix those large funds? You get an active share closer to passive, much closer to passive. So blending those large managers together reduces that active nature of them and gets you much closer to a passive solution with very high active fees. Just not a good solution for your clients. And so therefore I would suggest that alpha doesn't follow the crowds. It doesn't follow the crowds as an investor, as a fund manager, and it doesn't follow the crowds that crowd around a small number of very large funds as the bulk of clients out there sit in. So what is the solution? The solution is, in my view, and I think very objectively, is a major contrarian paradigm shift. In other words, doing something very different. And that is to construct a blend of skilled, high active share managers. And that's the key insight that I want to leave you with. It doesn't have to be with us, with Camissa, although I think we are a very good candidate for that. It's choosing managers who are truly active and who have skill and blending those together. Think about the implications of the firm size, of asset management firm size for client outcomes. The outcome quality screams down as their marketing budgets ratchet up. Think of the power of those big brands that they have over you and your clients, especially your clients. It's an enormous advantage for your clients to want to invest in those large brands that they walk past at the airport. Think about fees differently. Focus on alpha netto fees. Embrace active manager fees. If that's what you're truly getting is active performance. Welcome performance fees where the manager is very much aligned with client outcomes. They get nothing if they don't deliver and get something more if they do deliver very well for your clients. Very much an aligned solution. And perhaps reduce, if your clients are really worried about your total fee that they're paying, reduce that fee with introduction of passives into the blend. It gets you a better outcome to do that than to blend low active share managers together. So it's not the easy route, but in my strong and objective view, it's the right one. It's not easy to implement, but I think it's the right one to guide your clients towards. So putting that aside, that's the sort of background to the conversation today. Where do we fit in Camissa, and why would we be a good fit for your client solution? So getting back to this graph, the very concentrated equity market, if you look at where our positioning is, our portfolios are positioned today, it's there. So in those red boxes, you can see significant underweights in some of the large companies from position 10 to 15, zero, in fact from 10 to 20, none of those companies are in our portfolio. So you can see big deviations from benchmark weights. Towards the bottom of the top 50, you can see that's where our large overweights start to come in, and then 38% of our portfolios, more than a third of our portfolios, is outside of the top 50. And in that zone, in that last 10% of value of the total market, And I would argue very strongly and objectively put forward that we meet that first criterion. We are truly active in terms of our portfolio positioning. Getting back to the second sort of evidence that I showed of the ineffectiveness of large managers, looking at the mid caps that we can own. So our holding versus the large managers' theoretical 100% holding stake in famous brands, and I chose these particularly because these are large holdings in our portfolios. So famous brands, one large manager can own 2.1% maximum. We have 4.1% in our portfolios. Data Tech, 3.3% maximum, one manager. We have 4.8%. PPC, we have 2%. Rate, we have 3.8%. Omnia, 3.9%. Curo, 1.3%. Mathematically, just not replicatable by the large managers, and true active positioning in an area of the market that we think is fertile for really good returns in the years ahead. And then getting back to this graph, which is showing you the active share of blending large managers and where they sit as a standalone basis. Where do we sit? Graphing our active share of the last 10 years, you can see that we've averaged around 70%. And you can see that the deviations are above and below from time to time. So I think we very incontrovertibly meet that first criterion of being a truly active manager. And to the extent that we are active, I think we are earning our active management fees. Getting to the second point of being a skilled manager, I think one needs to look at long-term track record to assess that. We have been materially delivering in terms of alpha over 21 years and counting. And I think importantly, we as the team, the core of our team who've delivered this 21 years of alpha, of outperformance, are still together and still resident in our company. Breaking it into 12-month periods, the 12-month rolling alpha, so every single year that one can look at on a monthly basis for 21 years looks as follows. So 67%, 2/3 of the time over 1-year periods, we've been ahead of benchmark. And I think one of the points I made earlier was just that with a truly active manager who has skill, there will be times of disappointment. So there will be 1-year periods, 1-year patches that one's got to guide a client through a period where we slightly underperform. That's the price one pays for long-term outperformance. But looking at 5-year rolling periods, every single 5-year period that we've delivered over 21 years, there you can see that 86% of the time we have been ahead of benchmark. 86% of 5-year periods we've been ahead of benchmark. In other words, ahead of the average manager in this context. Now that's truly evidence of long-term skill. So as a highly active, skilled manager, what is on offer? We have a focused fund range. We try and do a small number of things really well. We do a low risk fund, our stable fund, medium risk, our protector fund, targeting inflation beating returns, our balanced funds in a global version and an SA version, targeting the maximum return given Regulation 28 constraints. And then finally, our highest risk funds are true active equity funds with an equity alpha fund, the track record I showed you just now, which has a bit of a global element to it as well. And then an SA equity version, and then our global equity fund is also available. Looking at their track records in turn and just looking at equity alpha balanced and stable, I'm not going to necessarily go through every single number here, but you can see substantial returns delivered over 1, 3, 5, 10 years and since inception. But looking at the quartiles at the top, mostly first quartile with 1 or 2 shorter term periods and other periods that we've just slipped out of top quartile into the second quartile. Substantial skill. That skill has been rewarded by many awards over the years, and this just shows you the last 7 years or so and a couple of the awards that we've won. And again, I'm not going to go through them in too much detail. So I would put forward that we are truly different in terms of what we offer to clients and truly are fitting the bill in terms of what your clients need. We're an independent investment firm with 77.6 billion Rand in assets under management. Around about a third of that is retail or unit trusts, and that's our fastest growing area. We are a true high conviction active manager, as I've shown, very differentiated relative to where the bulk of clients in this market sit. We're a large, stable investment team with lengthy experience together. The core of our team, as I said, owns our track record. We are valuation focused. In other words, we very much care about the price we pay for any asset that goes into your clients' portfolios. We have a contrarian orientation in that we often are looking at areas of the market or particular situations or stocks or securities where there is pessimism, crowded pessimism, and that's more than reflected in prices, and therefore you get a very good deal. And trying to avoid crowded optimism, where often that's the highest risk, where the herd is flocking towards good news and prices well over discount the prospects that are reasonably and practically going to be delivered from the popular stocks. And we are generalists by nature. We're the third best SA equity manager since inception, since 2004. And if you look at just the SA only category, that's the second best. We've delivered 15.3% per annum returns net of fees over these 21 years and continuing to grow that track record. So where does our current high active share currently lie? And looking, in other words, drilling into our portfolios very briefly. And I want to show you that it lies not just in the equity side, which is a key part of most of the portfolios, but it also lies in the asset allocation and the fixed income security selection. So in terms of asset allocation, I've broken our global balanced fund into a pie chart here just to show you that we are more overweight and higher weighted in global equities than local. So 39% global, 31% local. In terms of locally listed stocks, we are biased at the moment away from South Africa's focused companies, given our very low growth profile that lies ahead for South Africa and the pricing of those shares. And we are tending towards local equities, as I'll show you in a second, that just happen to be listed here but earn the bulk of their revenue offshore, earnings offshore. We have a big hedge, put option hedge in place within the portfolios to protect in these volatile times to the downside. And then on the fixed income side, mostly sitting in government bonds. So we are wary of the pricing in corporate credit instruments, and also the fact that these instruments are coming down in yield as interest rates decline, but are quite in favor of the very high yields that are on offer in the government bond market, both at the shorter end as well as at the very long end. Drilling into domestic equities, what is it that we hold? Our significant holdings and where we derive a big part of our active share is in the platinum sector, PGM sector. Valterra Platinum is the new name for Amplats, Northam. Then in the diversified minings, Glencore, which is coal and copper and other things. Exxaro is coal and iron ore. Omnia, I mentioned earlier. Then on the industrials front, a wide variety of businesses, some of the smaller businesses I mentioned already. But on the larger front, Prosus and Naspers, big position, our biggest position. And then MTN is a big industrial position. That's one that actually most of the large managers could own, but actually, if one looks at the portfolios, doesn't make many top 10 holdings. So very contrarian, very high active share positioning. And then on the financials front, very counter to what the consensus is doing, where we're getting a lot of active shares, not having much in the terms of banks and insurers, but tending towards one or two of the asset management type businesses like Quilter in the UK, which is a wealth business, which is pretty much nothing to do with South Africa, and we think has great growth prospects going forward. So a very different positioning in terms of looking at some of our larger positions. And then where our active share also derives from is having zero weights and a wide variety of other stocks, which would be anchor tenants in many of the larger manager and other manager portfolios. So first up on the resources front, no gold, which is, I think, very counterintuitive at this point in time in terms of holdings at a very volatile and supposedly risky time in the world, with lots of geopolitics weighing on people's minds. None of the largest diversified miners, BHP and Anglos, zero. And then on the large industrials front, none of the large, very popular consumer staple businesses like British American Tobacco and AB InBev, the brewing company, and then zero in Bidcorp, also a very popular South African holding, and then zero in Richemont, the global luxury goods business. And then finally, some of South Africa's best businesses, doing the best, where I would argue the reason we don't hold any of them zero in Capitec and Shoprite is because there is such crowded enthusiasm and crowded optimism about their long-term prospects. Their prospects at the moment and what they're delivering is superb, and I almost couldn't make a single criticism of them other than their share prices are just a little bit too high. And so a wide variety of our active share derives from zero weights in a number of these very popular stocks. In global equities, our big active share derives from the fact that we have a very large underweight positioning to the US. The US markets, as many of you will know, makes up well north of 2/3 of global equity markets, and we have pretty much half that in terms of weighting. We take that active share and deploy it in overweights in Europe, often in multinational European companies which have nothing or very little to do with the European economy, which is looking pretty low growth, but actually are multinationals which service the rest of the world and are very lowly rated or much lower rated because they happen to be in Europe. And then overweights in Japan, which is some very interesting dynamics unfolding as inflation returns to their economy and their corporate governance standards in Japan improve materially in the years ahead. And then drilling into sectoral positioning, here I've just drawn out a couple of the large positionings that we have. So in the consumer discretionary front, some names there that don't necessarily make many of the popular funds out there, Dollar General and JD Sports. Dollar General is a value retailer in the US. JD Sports is a athleisure, mostly sneakers retailer in the UK. Both of them have seen substantial share price falls of late, and they're high quality businesses which we think are very pessimistically priced at the moment. Then on the healthcare front, a key theme for us in our portfolios, and here we are in the pharmaceuticals in something like Bayer, and then in medical equipment that supplies hospitals in a company like Philips. On the financials front, which interestingly has been one of the best performing sectors over the last 5 years in global markets, which is quite a counterintuitive thing to say. And I think most people wouldn't have picked it as the top performing sector over the last 5 years. We've got some Japanese banks, Sumitomo and Mitsui, and then Prudential is a life insurer or the insurer that services Asia in particular and services and sells to many fast-growing economies in that part of the world. On the industrials front, we have Daikin here and Siemens. Daikin is air conditioning, and in a global world that's warming, you'd expect that an air conditioning, the leading air conditioning manufacturer in the world, would be quite highly priced, but actually at the moment it's reasonably lowly priced for a variety of reasons. Siemens is a German conglomerate, one of those multinationals I spoke about earlier, which has a wide variety of very interesting future-focused businesses like software automation business that if it was listed anywhere else in the world would be very, very, very highly priced. And so another, I think, a key anchor tenant within our portfolios. And then finally on some other stocks, some household names like Walt Disney and JD.com is like the Amazon of China, one of the Amazons of China. And then Applied Materials is a key manufacturer of components and machinery that's used in the making of semiconductors, which is a very fast-growing area of the world at the moment. Drilling into fixed income, or what we call yield assets, I'd position that discussion with just putting up the South African government bond yield curve. And here you can see all the major government bonds that one has available with their yields on the y-axis and their term to maturity in years on the x-axis. And you can see a very high yield curve, so substantial yields that are available to you for sort of 10, 15 years out, and well above 11% guaranteed by the government coming at you as a fixed deposit for 10, 15 years. And where we positioned is predominantly in the 2040 area, the 15-year area, and then as opposed to holding anything floating rate or cash or corporate credit, we're getting 9% guaranteed by the government for the next 5 years in the sort of 213 area of the curve. Now, that's what you will get if the yield curve doesn't move. Now, if the yield curve does move downwards, as we expect it should, because these yields are really, really high, where could it get to? Well, that's up there is where we think it should be, where it should trade. And that pink line is where we think the yield curve should be. And incidentally, that's where it was around about 5 years ago. So if the yield curve does move down there, you get an extra 22% from the 2040 to the 15-year area, extra 22% capital gain. Now, you don't need for it to move for you to get a good return. You still get your 11%. But you get that 11% per year for 15 years, plus a capital gain of 22% there. And then if, as the Reserve Bank is strongly suggesting, we move our inflation target down to 3%, we'd argue that that pink line moves down a further 1 to 1.5%, and you'll get an additional 14% capital gain from the 2040, the 15-year region, as well as an additional 6% capital gain at the 2 and 3, the 5-year region. So that's the major rationale for our, I think, very contrarian, very high active share fixed income positioning in virtually no cash, virtually no floating rate notes, virtually no corporate credit, and mostly government bonds. So in conclusion, I'm just going to reiterate a couple of the points I've made in closing. So the problem, as I said, set out, is that most investors follow the crowd, and most advisors do too. The solution is a major contrarian paradigm shift. This is the solution to the challenge that I laid out to you as I started. Construct a blend of skilled, high active share managers. The key concept I wanted to leave you with: skill and active share, true activeness. Think about the implications of firm size for client outcomes. Think about the power of big brands and what they have over you and your clients. And think about fees differently, as I've set out there. It's not the easy route. It's not the easy solution. It's difficult to get your clients to do this, but it certainly, in my objective view, is the right one. Thank you very much for your attention.